What's going on, everybody? 360 Digital Closing Bell here. I am your humble correspondent, Michael Tanner. We are live from an undisclosed location here in Denver, Colorado, episode 19 here on a wonderful Memorial Day, great 3-day weekend. We don't have an off day, though. No off days for the show. We are live, as mentioned, from an undisclosed location here from Denver. As always, I am joined by the executive producer, the purveyor of the show, the director and publisher of the world's greatest website, oilandgas360.com, Stuart Turley. Stu, how are you doing today?
Michael, I'm doing absolutely fantastic. I'd like to give a shout out to all of our veterans and all of those that have faithfully given to our country.
Yeah, no, we have definitely appreciate it. I love the green screen you're working with, the flag behind you. I love it. We appreciate specifically Tomcat contributing to the show. We really appreciate everybody's service. We have a great show lined up. We're going to talk ESG post-coronavirus, obviously the week that's upcoming in oil trading, the 360 official, not official fund. I'm actually going to take a new position out. We're going to short crude oil. Hint, hint. That's what we're going to do. We'll see how that plays out. And then as always, we're going to call up Stephen and Nick. As always, the show is brought to you by our friends at Adamantine Energy. We absolutely love them, and they are one of the leading consultancy companies in the oil and gas sector that are helping companies prepare for social risks. They are the leading consultants company for that. They're led by Tisha Schuler, who's the former CEO of the Colorado Oil and Gas Association. Adamantine Energy is helping companies thrive just like yours and help with their exposure to social risk and helping verify your options and how your responses, how your peer companies are responding. Because sometimes that's the biggest thing, not just what's happening, what you should be doing, but what are your competitors doing? That's the biggest thing. And you know what your competitors are doing? They're reading Tisha's weekly emails. They're one of the best weekly emails to sign up for. You can sign up for them at www.energythinks.com, which is a great URL in and of itself. But please go to that website, sign up for her Both Things Are True, which really she's giving insights into social risk, and your competitors are reading it. So if you're not signed up for, please do that. As always, you can check everything Adamantine Energy out at www.energythinks.com. And as always, please just subscribe to this show, 360 Digital Closing Bell, iTunes, Spotify, YouTube. We really appreciate everybody who's reached out and said they've left a review and won a shirt. I'm getting there. Coronavirus has been rough for us all, haven't been able to get there. So I will get you those shirts as soon as possible. Follow Entercom and Oil and Gas 360 on all of the social medias. Connect with me and Stuart Turley on LinkedIn. You can check out the Energy 360 Network by Entercom, available on the world's greatest website, www.oilandgas360.com, and iTunes, Spotify, and YouTube page, where we drop all of the best energy thought leadership. You hear from all of the gang at Entercom. And we have an interview on Tuesday with the big hitters at Neverland Sewell and the big hitter at Entercom, Aaron Vanderford. Stu was lucky enough to be sitting on the interview. This was such a big hitter interview. I was on no video and mute, just happened to play sole producer. It was a good time. It's a really, really great interview. And if you're interested in how the official, these guys are the leading petroleum reservoir engineering consultants when it comes to certifying reserves, when it comes to public entities having to, because part of FCC filings, you have to have a reserves in there. That's one of the biggest things, and these guys can certify that. They're experts when it comes to that, and it was a fascinating interview day. They've got some crazy charts, actually, which I thought was really cool. We'll make sure we'll have all of that posted in a video Tuesday. Wednesday, we have Alex Epstein, author, Moral Case for Fossil Fuels. I think it's our fifth author.
You bet. We have more coming.
More coming on the way. We've got some great ones we'll tout here very soon. But it was a great interview with Alex, who really he kind of comes at ESG, which what we're going to get into in this first chat here. He comes at it from really the other side of the equation. I really, really, really like it, and it's a great interview. He's a professional, man. You ask him a question, he tees up. What's very interesting is he's an energy guy. He's big into energy. He wrote The Moral Case for Fossil Fuels. Philosophy major from Duke. So one of the first questions I asked him was, how do you get in this space? He actually he gets that a lot. So it was a great interview. He's doing a lot of great work. You can check him out at all of the social medias. Alex Epstein. His SEO value is great. So you can just Google him. You can probably find everything about him. What else do we have dropping on the Energy 360 network? There's something else?
Oh, yeah. We are actually interviewing Buddy Clark. He is a very, very well-known attorney over at Haynes and Boone. He wrote a book on oil capital, and we're going to be interviewing him as well.
It's a thick book. That's a thick book. In Oil Capital, it's just basically like the outline of.
I'm going to give him a shout out.
We are. If you're on
It is a
YouTube,
good.
if you're seeing the YouTube, Stu's holding up the book. It is thick, and really it goes through. And correct me if I'm wrong, Mike. You're gonna send me the notes over. I don't have time
Oh
to
yeah.
read 350 pages, but I do want the highlights. It's just basically an overview of what from the 70s, 80s, 90s, because of the history of the oil and gas. Correct?
Oh, it is, and we're going to talk to him because he is on the Haynes and Boone energy tracker. He
Mm.
is also very current
Yes.
on things. So having a current and post is incredibly
Well,
important.
he's
So,
the co-chair of the energy division at Haynes and Boone, which is like the top oil and gas attorneys. Like it, so I mean, like they're prime. That's prime time. I mean, there's the big boys right there. So I mean, he knows what he's talking about, and it'll be fascinating. It's a thick book. I'm excited. I think we're gonna shoot for like 3 parts, kind of like a history from 70s, 80s, 90s, and then 2000s, and then hopefully what he sees going forward. It's fascinating because every time he speaks on these energy trackers, he's able to pull stuff back from like 84. It's like, whoo, I don't have that knowledge base. It's crazy.
I've enjoyed my discussions with him when I have had the pleasure of meeting him. He is a very, very sharp guy.
We'll have to get his. Well, I wonder what someone like Buddy Clark, who's been around since the '70s, thinks of ESG. It'd be very fascinating to get his opinion on that. We'll have to ask him about what he thinks about this because we're backing him up with Alex, or we're backing him up with Epstein. But I think that's a terrible segue into talking about really what I think are something that I think's been brewing for a little bit, and that's the ESG and versus the oil patch. And this is a question that I think Stu and I have been getting over the past couple of weeks, ever really since this oil price crash happened, was what's going on with ESG, which is, if for those of you who don't know, it's environmental social governance, as it pertains to investing and how it looks moving forward. And there's a lot to unpack there. It's not as simple as, oh, here's my thoughts, because really when you look at, okay, well, how do you project something going forward? Well, it's best to get an idea of what it is really. So what is ESG, where it was before this monumental shift happened, and then we can best use all of that data to take a guess. And I mean guess very, very loosely. We're just guessing about what we think is going to happen in the future, and that and so that's going to begs the question, that first question, what is ESG? As mentioned, it's environmental social governance. And basically what market watching, you can actually, what I would recommend is going to oil and gas, it's a market watch article, but we're going to have this article up on oilandgas360.com. We'll title it, we're going to have some show notes in there. It'll be a publisher's note with some title because we're going to put our own stuff in there. But it does a really good job of laying out a lot of the different stuff as it relates to ESG and where it was really before this virus happened. It was dropped on December 18th, 2019. So it's fairly updated before kind of this virus and price war with Saudi took over and really, really completely, absolutely changed the way the industry. And that's, again, why we're getting these questions. So ESG attempts to encompass how a company is performing against a rubric of non-financial risk that can't be measured as a line item in corporations' accounting statements, but it could still harm it economically if incidents around these risks arise. For example, safety. One of the big things that people don't understand is, social governance when it talks about safety. And, one of the biggest things that companies talk about when it comes to this is their safety record. And so that's more than just, hey, we're not going to flare oil, we're not going to flare gas, or we're not going to emit CO2. It can steep even to beyond to safety and how you, and how you deal with all that sort of stuff. And so that's what ESG, really is. It's very tough to sort of put in a simple box. And really, I think the best person that puts it in a box is Tisha, because this is what she spends her whole career doing, is trying to take this. And she's told me this. It's how do you, this idea of ESG is, and this is what I love about this and why I like this quote so much from this article is, there's such an abstract, ESG is such an abstract idea that it takes a lot of thinking to how do you take this abstract idea, put it in a box and deliver it to somebody, because it's an abstract idea. How do you, because think about it, it's ESG attempts to encompass how a company is performing against a rubric of non-financial risks that can't be measured in a line item in a corporation's accounting system, but could still harm it economically if incident is right. It's very hard. That's an because now these risks that you come across, it's an abstract idea. And so I think that's where some of the confusion lies, is specifically that you can't measure any of this on a light item, but it's basically how how everybody thinks you are impacting the society. And I recommend, if you want an idea of what ESG is, go to energythinks.com. They're going to do a much better job of taking this abstract idea and putting it in a simple box. But that's what it is. I think if you most people, I think, in the oil industry know what ESG is at its core. So I don't want to spend too much time diving into what it means and what it doesn't mean. This is, I think, just the most comprehensive. Or if you want to learn more, there are experts on this, and you should go check them out. Specifically, Tisha, and we love the people at Adamant Team. Another shameless plug. So the next question is, well, obviously there's an idea of what it is. The question is, where was it? And in terms of how was it affecting the oil industry? Where was the ESG and the conversation going in the oil and gas industry? Well, to give you an idea, it was on the rise and it was booming. And there's 3 specific data points I want to pick out. Investment funds that were focused on what is called SRI, or what's called socially responsible investing. And these are basically funds that invest, and they have a criteria that are called, they actually create a criteria that is specific to social responsibility investing. Those funds have grown to $17.67 billion through November of 2019, up from $2.38 billion in 2015. So about 2.5, maybe 3 years, there was a 3,000% increase in the amount of socially responsible funds through November. Second fact, U.S. Forum for Sustainable and Responsible Investments estimates that around 12 trillion of assets in the U.S. are managed under some sustainable investment strategy as of 2018. So 12 trillion of assets managed in the United States have some sort of sustainable investment strategy baked into every decision they make, which reflects a huge growing demand for investments that are aligning with quote-unquote client social values. Here's the third one. Here's the scariest one, I think. Or not the scariest one, but here's, I think, the hardest hitting fact. Is according to a survey by KPMG, they're Big Four accounting firms. I think we'll take the data for face value. 75% of the largest 100 companies across 49 countries say they are employing ESG business models or incorporating aspects of sustainability approaches as of 2017. Compared to 12% in 1993. So that's a big gap. But over 20 years, you basically have no one in the industry dealing with it to everybody in the industry is dealing with it. And that's what I would consider a 12% to 75% swing. So ESG was growing, and it was growing quickly. And how is that? How was that affecting the oil and gas business as it pertains to capital? Because I think that's what we're interested in. We're oil and gas finance show. How is this growth in ESG? So we're seeing all this money flow into ESG, but what does that mean in terms of how is that hitting the energy business? Well, there's 2 reasons. This money is all flowing into pensions funds, mutual funds, large capital funds that invest in a wide variety of companies. And these are the institutional players who they deploy tens of billions every single year, and they deploy it in thousands of sectors. Every mutual fund's in everything. Institutional money is everything. This stat changes a lot because there's only 6-7 players in this business, but institutional money is somewhere like 80 to 85% of all capital that's invested is what is considered institutional money. Someone's retirement account, a pension account, a private equity, mutual fund. All of that is like 80 to 85% of the market. So me day trading at home, I am nobody. I am a little small guy. We don't affect the line item at all. But these big boys do. I tell people, look at a 13F file. If you really, 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 really want to know who's investing in companies, go look at a 13F. 13F is public companies like companies that invest mutual funds, pension funds, companies that have and invest money as a professional are required to disclose their holdings. Go look at any companies, go look at any of the top public companies in the oil and gas business. Look at their 13F. It's the same companies. I'm looking at Exxon's right now. Top 5 13F holders. Vanguard Group. Number 2, BlackRock. Number 3, State Street. Number 3, BlackRock, another firm. 4th or 5th, FMRR. So all pension and hedge funds. All pension and institutional funds at the top of Exxon. It's the same. We could go through hundreds of examples. I'm not going to do that. Just trust me. Go look at the stats. It's there. I'm not lying to you. So institutional money, 80 to 85% of the capital available in the markets at any one given time is institutional money, which has this idea that ESG is a big thing. So how does that affect E&P companies? Because, well, it affects them in a lot of ways. I think, I think a lot of people say, well, if that's just where no one, well, that doesn't matter. It's just going to be institutional. It doesn't matter what institutions do. It really matters what's going on in the oil business. Well, sorry, guys, oil's not been, hasn't been making money in the past 5 years. E&Ps had to raise money beyond revenue in the door. We're talking about, we make fun of non-GAAP cash flow, but that's just a fancy way of saying we're not making any money, but we've got new loans. We maybe got some new credit lines. We found a new private equity partner. So, I mean, E&P companies raise money besides just selling stuff, besides actually bringing money in the door from selling something and revenue. I love you look at a 10Q or a 10K, excuse me, on an oil and gas company, and there's some interesting things you see on some of them because they have to list everything they do. It's part of the SEC. So E&P companies, they bring in money all different ways, and loans, credit lines, PE money, that all ties back to pension funds because it's all or pension funds, and that what we would specifically call institutional money. I should stop specifically calling it. It's institutional money, and I'm going to loop private equity in with that, even though they may be a little more bullet friendly with the investments than because you can find private equity money who doesn't necessarily care about ESG, but that's a rarity to be specifically, because specifically the returns just haven't been there, and we'll sort of get into that. So that's sort of how ESG and this idea, that's sort of how the connection is made between ESG at institutional level and the E&P companies. And so really the consensus was a mixed bag within the industry. I think if you just took 20 average oil and gas employees, I'm going to leave executives out of this because they're a different category. If you just took employees who worked, specifically that, employees, I think ultimately they would see ESG as a sort of, and I say this, I don't mean negative as a bad thing, but I think they saw it as a net negative. They thought there was some upside to it, but ultimately I think a lot of these people saw ESG as sort of a bottleneck in how to just more efficiently do their job. Hey, I've always got, now all of a sudden I've got this, I have to fill out an extra report every single day. It takes me another 20 minutes a day to fill out one more piece of paper that says, hey, we have to do, our JSAs, our tailgaters have to be 20 more minutes long because we have to cover all of these different things. I think employees, they saw that there was maybe value to it, but I think ultimately saw this isn't moving the needle for me, so why do I have to do it? Because there's no different than what we were doing before. I think you saw executives, and this is why I separate executives and employees, because I think you saw executives embrace it. And if, most people listen to this on the podcast, I'm doing that in air quotes. They embraced it. And I'm not making a judgment on whether they enjoyed the embracement or they agreed with it or not. I'm just saying executives embraced it, because if you look at all of the companies that have specifically, and the easiest way to see ESG is just go look on a company's website, go to if they're a public company, go to their, or they're a private company who's, private companies usually not, because it really depends on who's their backer. Does their backer care about it or not? But if you go to public companies, all of them have ESG approaches. I mean, go look at Chesapeake, your friends of the show, Silverbow. I looked up all these before. Oxy's got a great page. Continental, Harold Hamm, for goodness sakes, has an ESG page. You can go read it. It's on his investor relations board. So executives, whether they liked it or not, are embracing this because they understand how just money flows. Because what's the job of an executive? How do you bring in cash for your company? And that's partly why have executives embraced ESG? Cash. It's all about the cash. Generally, they get paid off one amount of cash they bring in. So how much they bring in for the company, whether it's oil revenues or whether it's access to other forms of capital, whether it's public or private. And specifically, public is, how is my stock price growing? That's access to market capitalization. Are the institutional players, are the mutual funds investing in my company? Because as you saw Exxon, they don't care if Bob and Sue and me and Stu sit here and buy a couple shares of Exxon. I don't own a door handle of, and my dad used to always tell me when I was younger, he was trying to teach me, he's like, yeah, like basically you buy a share, stock works like you have ownership of a company. You buy a share like you own the door. Like, that's not quite how it works. Not quite how it works. But like when you look at Exxon, it's Vanguard, BlackRock, State Street. Like these are large mutual funds that the average person's pension fund or the average person's retirement or 401k, we've all got a 401k, is probably invested in it. Go look at what your 401k is invested in. You're probably just in a Vanguard fund. They're the largest, they do the most amount of liquidity when it comes to institutional investing. So so that's what it means. That's what we mean by public capital, access to capital in the public markets, institutional. When we look at private, these are just, when we look at private capital, these is debt offering, senior notes, private equity people, the other institutions that are, all of these funds, 17 billion in SRI investment funds, specifically invested in 17 billion. Goldman Sachs has mentioned they won't IPO any company that doesn't have a sustainable ESG program. BlackRock, the list just continues to go on and on and on and on and on. And part of the reason why, and this is part of my beef with EFT Twitter. I love EFT Twitter for a lot of reasons, because they've been hard on shale oil. They've been really, really hard on shale oil and gas. And I think they've been too hard on it, but I think ultimately they got it right. I think a lot of shale oil was, I don't want to say a scam, but there was no returns. I don't want to, the theme on EFT Twitter, which is just because it's Twitter, so they go a little beyond. They think shale oil and gas was a Ponzi scheme. I don't go that far. I don't think it was a Ponzi scheme per se, but there was definitely not that great of returns. If you could get in and get out very, you could have played it well like any day trade, but over the long term, the returns actually haven't been there. But that can just happen. That just can happen for a period of time. It's if you look over 25 years, the oil and gas industry has grown tremendously. So it just matters what lens you're looking at. If you're looking at a 10-year lens, yeah, maybe it hasn't looked that good. But I plan on being around for a long time. So these little intermediate changes don't necessarily get me as much. And so where this gets with me is if you just look at the data, and that's basically what I sort of wanted to do here, was lay out the data. And if you want access to money, whether you agree with it or not, and I make no judgments whether or not this stuff is, that's not my area of expertise, whether this stuff, how to implement this stuff, what it is, how to actually do it. But what I'm saying is, if it's not a part of your operations, the data is just telling me that you're not going to have access to the capital. And this is the other thing that gets me. This is actually another shameless plug to a great sponsor, Adamantine Energy. She wrote a report dropped in December. And this is actually a report that I got to help her do some research on. So it's partly what I know. Basically what it was an overview of demographic. We basically pulled a bunch of public data that's available on, you can actually go check out this GitHub at Adamantine Energy. It's github.com/Adamantine Energy. You can find all the data that I pulled through this. I put it up there. I'm eventually going to turn it into sort of a part of it. I eventually am going to turn it into a front end portal where you can log in on our website, download all of this data. And so it's sort of building in, my goal is to build sort of an ESG database for her, because I think I think there would be a lot of need for that. So if anyone is interested in helping with that, email me or mtanner@enercommeet.com. But you can take all of that data, and basically what it shows is it's a snapshot of what does the ESG landscape look like from the public data side. And basically what we did was pull demographic data, we pulled voter registration data, and we pulled pretty much every poll that had global warming in it. We were talking about Feedly, you were talking about an RSS feed. I did the same thing for polling and tried to work back and find all climate change polling. It was unbelievable. And what the data showed me about basically what the public perception of oil and gas honestly shocked me a little bit. I mean, I was generally a little more, because like I said, within the oil and gas industry, the general consensus was ESG was kind of annoying. It wasn't a scam. It was just annoying. I got to do this extra little thing. I got to fill this paperwork. I got to deploy a new page on my website. I have to invest a little more money into carbon capture technology and stuff like that. But when you look outside, you go outside the oil and gas industry, I mean, the data is clear. I mean, 2 out of every 3 Americans think the oil and gas industry is contributing to climate change and that we bear some responsibility to fix it. That's just what it shows. I mean, if you go look at this report, it's on, we should post this on Oil and Gas 360. We can go to energythinks.com / I forget what the backslash. I think it's /insights / will Texas ban fracking. It's a lot of and not to get too deep, not to spoiler alert about what the article says, but yeah, everywhere is turning. Colorado has specifically flipped. Every 2 out of 3 Americans, and so whether or not me, you, and if we're me and Stu and you listening, whether or not we all 3 agree with that, it doesn't matter, because it's what everybody. We can have a different debate on whether we think that's true or not, and that conversation is left to experts, not like me. It's left to Alex Epstein, Tisha Schuler, all these guys all these people in the industry that know this space better than I do. But I'm just looking at the data here. And so, That's what's happening right now. And so when we ask ourselves moving forward, so in light of all of that, what's happened? What do we think is going to happen with ESG post coronavirus? And who knows when and who knows what. But I want to bring Stu in here before I kind of you've been hearing me for a little bit. What do you think? So in light of all that, where do you think ESG's headed post coronavirus?
Very, very well said, Michael. I thought you covered a lot of it very well. I
Thank you.
think post COVID is going to be even more important on ESG. And ESG is being driven not only by the financial arm. If you don't have an ESG current plan that's being worked and demonstratable ESG plan, financial companies are not going to be interested in you. But this is being driven by the consumer. So the consumer is demanding ESG. The consumer is starting where all this is rolling to. So those oil and gas companies and energy companies that survive post COVID will have a implemented ESG plan. It's just part of it. There's a couple things that have just come in across. And by the way, I want to give a shameless plug and shout out to friends of Intercom, Liberty Oil and Liberty Frac Services. They are phenomenal about ESG. Michael, you and I have always talked about good management, good numbers, good people. Liberty Frac also took their when they had to do cuts and layoffs
I
because
remember
of
we covered this. It was 60% executive cut. That's deep. That's
executive
deep.
cuts. And one of the films last year, I'm going to regress just for a minute to give them a kudos, was I was sitting there just looking at YouTube one day, and they said our frac solutions are so good for the environment. They lined up a whole team of their employees and drank their frac fluid.
That's awesome.
I mean, that's
That's
putting your
cool. Yeah,
responsibility right on the line. And I was like,
that's awesome.
wow. So
Yeah.
Chris Wright is phenomenal. And I can't wait to get you on the interview with him. He is one of the good people out there, but everybody at Liberty is good. That also being said, that leads me up to this next piece of it. And even though the consumers are kicking in, going to be part of the driving force of this, you're going to have not only the oil and gas industry having to have an ESG plan in place, it's not being articulated very well to the, I don't want to use the word, but the radical climate folks that are out there that are just saying no fossil fuels. And one of the things that just came out is pretty crazy. And it's going to be dependent on whether or not natural gas is going to be the bridge. I'm holding up my fingers in air quotes for to go to renewables. And renewables is a whole nother topic. But the reason I'm bringing this up is because there's a new technology out called the Race to Zero Emissions, and it's called the Alam cycle. It's a new gas power plant design that can theoretically capture 100% of the emissions while being cost effective and efficiently competitive. It's only about 2%, Michael, in order to capture 100% of the emissions. Now, whether or not
Interesting.
CO2 is bad is not the question. There's two things happen. The natural gas as a organization and as a industry talk about how little impact natural gas fossil fuel burning gets having one of these bad dogs on it and then this type of thing is going to be incredible. I mean, that is a game changer for. Do what?
It is. No, I just continue. I'm about to agree with you, so go finish up.
Oh, don't agree with me. Don't, Michael. I think that if a couple things can happen, let's go through these steps. Oil and gas companies that survive COVID will have a active working ESG plan.
Let's do.
Anybody that can the oil and gas industry as an industry describe that fossil fuels are not bad, and will this have the ROI? Because I don't know how expensive this technology is. I have to do some more research on it. But zero emissions on a coal-fired plant, that's critical, because you and I have talked about with Gregory Wrightstone, we've talked about it with Alex Epstein, we've talked about it with Tisha, we've talked about it with all of our other Dan and Aaron over at Intercom. The importance of having the energy provided at what are we best market price,
low cost, scalable energy.
Exactly, to lower people out of poverty. Absolutely. So if the ROI on this product and this new technology is there, that product could be the bridge for the natural gas industry to bring into the bridge for the ESG. I don't know. I don't want to use the word left wing, but hyper focused folks, if that makes sense.
No, I think you hit the nail on the head a couple different times, and there are a couple different things I want to pull out from what you said and agree with you. So, first one is you mentioned education, and that is the biggest topic that I took away from the Alex Epstein interview, which you guys can watch Tuesday, was educating the public on the actual impacts of fossil fuels, specifically natural gas, fossil fuel burning, is critical, and educating people on renewables and the entire value chain of that, which you can check out at the Planet of Humans interview, is absolutely critical into moving forward. So any ESG plan has to have, I think, an education piece to it, because I think educating people about exactly what's going on. But there's also a balance that needs to be struck. So yes, both, and this is another plug for Tisha. She writes this weekly article called "Both Things Are True." This is another area where both things are true. Yes, we understand that fossil fuels and burning natural gas specifically is actually very clean, and if done correctly, is probably the solution versus renewables. That can be true, but it's also true that 2 out of 3 Americans think that oil and gas is responsible for climate change, and that we need to fix it. No morals, that's just the data. You go look at every single poll there. So both things have to be true, and there's a balance that needs to be struck. I think as we move into the future, oil and gas, specifically shale, because it's proven to be, honestly, in the aggregate, a terrible investment. It's only going to become more important for companies spinning up. There would be no private equity. There's going to be no new private equity companies, I think, that spin up that are going to not have an ESG plan. Because I just don't think that's how it's going to happen. No public oil and gas company is going to be able to not have an ESG plan, because the institutional funds are not going to invest in them. Private equity, as I mentioned right before, private equity, you might see some, because there are certainly some private equity energy-based works that they could care less about ESG, and you don't have to have that. But from the public side, if you're going to try to go public in an oil and gas, or you are an oil and gas company that are public, and you're not embracing this stuff, you're doing yourself a disservice, because the data just clearly shows that from capital, from public percent. I mean, what 2 things do you care about if you're an executive? What's my capital and liquidity status, and how do people like us? Both of those ESG is completely intertwined with. And whether we agree with that or not, we will leave that up to people smarter than Stu and I.
Hey, Michael, just as a shameless plug, this is an international item. You and I are interviewing Heidi McKillop. She is the producer and director for Stranded Nation up in Canada. She has put out a beautiful film and talked about how all of this is impacting Canada. So we will be interviewing her on Thursday.
Ooh, well, that'll be fun. I will look forward to that interview. But that's kind of, I mean, I think from my end, I think I've covered it fairly well in terms of the things I needed to sort of get off my chest. I think, it's my personal beef with EFT Twitter. I think they get a lot of things right. I think they got the ESG thing wrong. I think they think ESG is a scam and a fraud. And okay, you can believe that personally, but you can't let that affect the way you go about looking at how companies are going to thrive in this environment, because I really think the only way companies are going to thrive is if they've at least embraced this. Even if they're making it all up, you have to have a presence. Even if you're making it all up, you have to have a ESG presence.
You know what, Michael? If the oil and gas executives and the energy executives used ESG not just as a checkbox, but rather an opportunity to educate the people that follow them on what ESG means to the fossil fuels and the benefits. If they use this as an education platform, it would have a very, very broad effect.
I think it's I agree with you. I slightly push back. That's the education piece. I think is big, but I'm spending so much time on education. You're not going to change some of these people's minds. It seems like you might be fighting an uphill battle trying to convince everybody that fossil fuel. I mean, I'm asking out loud. I think education is key, but at the end of the day, I think I think the majority of people are just not going to like oil and gas, and there's a way to do that. I mean, tobacco thrives. People hate them. You know what I mean? Like it's
Oh yeah,
so I
but you
mean,
got to
just
try.
you do have to try, but at some point, yeah, trying is good, and that's what you should do, because that's the only way you're going to get capital. But at some point, you can only educate people so much before you're just fighting an uphill battle. But like I said, we leave that stuff to the experts, and we don't touch that. So I think we covered this well. I think it's time to shift into the week that's upcoming in oil and gas. As always, this segment is sponsored by Sandstone Capital Group. These guys do insanely good research. They provide all the levels from their energy solution. Please just check them out, www.sandstonecg.com. They're the energy market research experts. I love those guys. Email them, Connor at sandstonecg.com, 949-561-1818. Mention the podcast, 360 Digital Closing Bell. If you don't, we don't get credit. It's great that you called them. We love that, but you don't get credit if you don't mention the podcast. Really, in the week that's upcoming, there's just two stories that I think we missed that dropped last week that we didn't cover on Friday. That one of them happened on Friday, so we didn't, we record the shows a day before we release them, because that's just how it has to be done. So there's a story that dropped Friday I want to cover. There was a story Monday, though, that I missed, and I'm sort of not sad I missed it, but we didn't cover it to the depths. One of the big segments we covered 2-3 weeks ago on the podcast was talking about whether or not we thought the government was going to intervene, and what we really think how the best way to intervene, if there was a way for the government to even intervene in the oil and gas industry right now. Stu and I's opinion, and correct me if I'm wrong, but we're free market guys. So we're sort of, we were against proration. We were in each state, now it's been Texas, Oklahoma, and North Dakota. We were, the way that there were some of these, some of the stimulus money was going to, the ways they were thinking of stimulating just specifically the energy business was, I thought, kind of insane. But what they did on Monday was the Trump administration started giving energy companies temporary breaks on their royalties that they must pay for the oil and gas they're extracting from these federal lands. They dropped that rate from 12.5% royalty rate all the way down to 2.5%, which is probably the best method that you could do for helping out companies, because about 25% of all oil and gas drilling occurs on federal land. So you're giving and generally federal land is done by smaller oil and gas cap companies. It's generally done by that, because a lot of that federal land doubles as farmland and grazing and like public grazing land, which, not all of it, but they back up very similar. So a lot of the same people that operate, a lot of these smaller guys, no small guys aren't paying $100,000 an acre down in the Permian. and the government doesn't own that land. But on a lot of these federal leases, you can get a lot of these small guys. So this is a great way. I love that the Interior Department of Bureau of Land Management did that. And that they were cutting rates if you could show that they could not successfully operate public energy leases economically or can't maintain enough employees at the actual drilling sites. So that's a great thing to see. That's probably one of the, it's just, I wasn't really thinking of that when this all happened. I'm glad the government was, and that's, it proves that there are some smart people there, or I'm just not that swift. So whatever you think doesn't matter to me. I think this is a great move, happened on Monday. This is one of the few steps I like that happens. What did you have any thoughts on it?
No, I would agree with you on that as well. I know that we believe in the free market, but there is a little bit of a caveat you and I had talked about on the free market, and that is that OPEC and all of these other big conglomerations come up with their own price involvements.
Yeah.
So you can't say that the oil market is 100% free
It's
market.
not. It's not an efficient market because it's a commodities-based industry. So I completely agree with you. There's a way, and I think this is a good way. This is a decent way to go about it. This doesn't bother me. I think this is actually for a government intervention. You get an A+. You get the finger dance from
Yeah,
us.
we get the Zoom thumb
We get
dance
the
for
Zoom thumb dance. So that's our little thing we do for everybody to listen on the podcast. The other story that dropped Friday that we didn't get a chance to cover, but I thought was really interesting, that sort of pertains to sort of the private equity side of where things are going. Kane Anderson Capital Advisors, we should start calling him Kanye Anderson, but Kane Anderson Capital Advisors are going to consolidate two of its private energy equity companies, and one of its managing partners, Chuck Yates, who's a titan in the industry, is going to exit the firm. Sources familiar with the matter told Reuters. Ooh, this shakeup is one of the largest in the private equity investor in the oil and gas, and it comes as the coronavirus outbreak ravages the energy industry with oil prices plunging below zero for the first time last month. Ooh, Reuters article scary. But no, that's my Reuters scary article narration. But basically, Chuck Yates, titan in the oil industry here when it comes to private equity. He's going to leave. He was the guy that was managing basically both of its one or two of its large private equity teams. Why this is why this is important is because Kane Anderson is the largest private equity investor. Beacon Oil, Exploration Oil and Gas Company, Axia Energy, Crestwood Midstream, Ensign Oil and Gas, Invictus Energy, Meridian Resources, Medicine Bow Energy, Momentum Oil and Gas, Plains All American Pipeline, which is one of the largest marketing companies. They are an absolutely one of the largest refiners. Friend of the show, David Forsberg. Every time he pulls crude oil stuff, he likes to go to these guys. So, I mean, these guys were the premier, and they're pulling back, they're tightening up, they're consolidating. It's unfortunately this is more of a sad sign than oil price tanking, because this shows that they think even long term they think it's going to be a large fight back. This contraction, it's not sad to see, but this was just a source of revenue or a source of money that companies could go out and get other than the public sector. And so when you see this happen on the private equity side, it's that doesn't necessarily excite me for the future. Stu, what do you have on the international side for us? The international news desk.
The international news desk. I'll tell you, what's fun is the feedback we've been getting worldwide is just phenomenal. You helped bring this one to the attention. I want to give a shout out to you on this one, but you and I had also talked about Iranian bypassing the ships and bypassing the sanctions. And ABC actually came out with this story. We will be having some notes up, and I'll have a summary of it up on Oil and Gas 360. But all the ships coming in from the Iranian ship first reaches Venezuela with no sign of U.S. threat. The first 5 tankers loaded with gasoline sent from Iran has reached Venezuelan waters.
Late Saturday. This happened last night. This is
Yes.
early hours weekend stuff.
Yeah. So, I mean, this is big time stuff, when
No, and
it's
it's
not being, if the sanctions are not impressed, that goes right back into other things that affect oil prices.
yeah, and it's interesting because they're in a fuel crunch right now. Venezuela, has theoretically elected a Democratic governor, Juan Gallo, who is being shut out of government by currently the president, in quotes, President Nicolas Maduro, even though most all of the free nations in the world have declared Juan Gallo the acting government, like they basically disavowed. So it's really hard to call Maduro the president, but we'll do it. We don't even. No, he doesn't even get that title from us. He's just Maduro. He's bad guy, because he's killing them right now. They're in a fuel crunch, and I think they're going to let this happen. My guess is that they're going to let they're going to let these tankers come in. They're going to let this fuel get in there as sort of a sign of good faith. I mean, we covered this months ago, but there was there are multiple, basically, the Venezuelan border. There's only 4 or 5 ways to get in, and they're all huge, not tunnels. I'm bridges. I don't space in the word bridge. I talked for 45 minutes. I can't come up with the word bridge. They've got bridges that all go into them. There's only like a couple ways to get in, and they're all blocked off. And the U.S. has aides sitting on the other side of them, and they refuse to get it. So, I mean, I think this is a sign of good faith on the Americans. Let them get some, critical
Excellent point.
fuel. Get some fuel. I think this is maybe a sign of good faith. But yeah, it is. There's a
The article does say because they have so much shortage in gasoline, it is a social issue, and the tankers appear to hold what would be 2 or 3 weeks worth of gasoline for Venezuela. Pretty important. So good, excellent point, Michael.
Yeah, and I mean, and one of the biggest things is that there's 5 ships about 3.5 days behind just showed up. So I think this is big from a standpoint of from an international. This covers not just international news, but international world relations. I mean, this is now you're involving the Iranian government, Venezuela. Like I said, I think it's a sign of good faith. But yeah, it'll be very interesting to see whether these Iranian tankers and they did 2 to 3 weeks, like you mentioned, of gasoline, which we'll be back in this joint in 2 to 3 weeks. What else do you got?
Um, we also had Putin. You always got to love him.
Yeah,
I
what's he
mean,
doing now?
oh, he's, when you sit back and take a look there, you and I have enjoyed President Trump's tweet, and you got to love Putin. So on Putin, he's got an article out. Actually, came out from Bloomberg in Moscow. Putin sets deadline for plan to support Russian oil industry. So he's looking at subsidizing his oil industry due to this price war going
Yeah.
on, and he said they will move ahead fully in line with the deal in order to help do this. So you got a big thing in this article. The oil field and gas, Russia is put in some serious price issues because of all of the other natural gas folks in Europe tired of being held hostage from
Yeah.
his pipeline on natural gas. This is now he is now in some real dire straits of low pricing. He's having to finance more of his own oil companies to keep them alive. And then you have the people that are starting to buy from the Leviathan field in Israel. Whole big wild thing from Putin.
No,
Gotta love his energy.
he's got himself in a love triangle. The love triangle between him, Saudi, OPEC. It's incredible. The U.S. That
And
that game of monopoly is unbelievable.
oh, it's crazy. So this will be on Oil and Gas 360 with
Yeah,
some
all of these
summaries.
articles, please find oilandgas360.com. When we look at the levels for crude oil for the week, market close 33.25. Really pivot point for the week, 31.50, 31.95. So we're about $2 above where we think the pivot point, which is the bit way. In my opinion, I choose my pivot point based upon where just the biggest volume chunk is. So that was where the most. It was 18th, 19th, and 20th was really the days it hung out in that $32 level. We've recently bumped up. We touched 34.36. It was like 34.50 was the high. 34.60 was the high for the week. The levels on the upside, if you're a bull, I mean, 34, 36, I think is a good level. You're really anything above that, who really knows? Remember, we saw the gap down from 42 to 35. And we haven't seen that 34 to 35 in 20 years, 15, I think it may have touched down there a little bit. There's some volume of it. It's tough to find. I mean, if we go back, crude oil, all the years, I mean, yeah, it's tough to find a price. Is definitely a chunk there. So, I mean, that is I'm not going to speculate the levels in between that. If it does trade above $35 and we get into that gap zone of what happened, I will be, obviously I'm not going to be trading that section. So if you're looking at getting in at those levels, it's just remember, I couldn't tell you what's happening. It's hard to set levels when specifically on my side, there's no volume to base it off of. If you're a bear, which, spoiler alert, that's going to be my bias for the week. I'm actually a little bearish on oil. I think we've reached sort of the crest. I don't think we're going down to negative pricing. I don't think we're necessarily going down below $20, but I think if we saw oil dip below into the high 20s, I wouldn't be necessarily surprised. I think 32.73, 32.01, 31.49 in the downside, I think are good levels to watch for. And I think you could see anywhere 28.92. The level I'm looking for is 27.90, but we will get into that in the 360 official, non-official fund. When we look at the COT, that's the next thing we have to look at. This is something actually I want to ask Nick Berry about because he was mentioning this to me that managed money on the hedge fund side cut contracts last week, which is very interesting. You would have thought hedge funds and professionals adding long contracts as oils continue to be low, but they're actually cutting their longs, which is sort of a sign that, in my opinion, I think hedge funds think 30, 34, $35 is the cap. And that's partly my bias is on the short side this week because you might see some more of that hedge fund money continue to flow out. They also cut their shorts though, but those are mostly people probably cutting their shorts that they had on from, $15. And I think a lot of people got eaten out of shorts last week. So I think you're seeing a lot of shorts cut and a lot of specifically longs cut because I think people are just a little scared. They don't see the upside anymore. And that's really all I've got for the week upcoming in oil and gas. You got anything more before we move into the fund?
I think we've had a lot of coverage there.
We have had a lot of coverage, so I think it's time to go ahead and move into the 360 official, non-official fund. But before we do that, as always, the lawyers make us say this so we don't get sued. As always, this segment is for entertainment purposes only. Everybody on the show, me, Michael Tanner, Stuart Turley, invest money for our own account. We do not manage any outside money. We do not give investment advice. We do not offer securities or have any involvement on the regulated side of the industry. Investment is risky, and you can and will lose all of your principal. That being said, Stu, how's your portfolio looking?
Pretty mediocre.
That's okay. Mine's looking mediocre as well.
I'm not going to cut anything on that. You and I had talked on Friday that I'm redoing and taking a look at some of mine. My Duke Energy is really hanging in there, and I really am still feeling strong about my LNG Geopark. I'm still hanging tough in there, but Rattler I'm almost out of everything else and out of Enphase. So still hanging tough with Duke and LNG and Geopark. I've got about 4 other picks I'm working on.
Okay.
And Tomcat's out till around Tuesday or Wednesday. He's going to tip his, we're going to have a chat, see what he's got coming up after that.
Yeah. I love it. For me, the only thing I'm doing, obviously, I'm in Bonanza Creek. I'm up about $2 per share, so $120. Great job. I got 2 contracts on natural gas. Natural gas, $1.76 is my average entrance point, so $1.73. So we've lost a little bit on that. I'm short in CL for the week. Obviously, commodity futures are going to be trading tonight. World oil markets don't close down because of Memorial Day. So I'm going to go ahead and pick up a short here, probably when the market opens about 3-4 o'clock, specifically Sunday afternoon. And I'm just going to kind of ride that boy all week as a portfolio short. Put my money where my mouth is. That's where my bias is. I don't think we're going to get above 34, 35 bucks and, sitting at 33.25. I may see what the market does originally when it right opens, but I'm looking to get in and find a level, maybe 35.65, maybe get up. Maybe if it does get up to 34.36, find a level to short and ride that puppy all week.
I know we're running long, but do you think that the holiday weekend, if everybody got out and did a lot of demand, would cause Wall Street to like the oil price?
I don't know. My thing is only retail investors. Specifically why you should not trade commodities futures or if you are trading on Monday, but you can trade certain markets, you can trade gold, you can trade Forex, you can trade stuff, you can trade not US stocks, but you can trade European stocks, you trade the Chinese market, you do whatever you want.
Right.
No professionals are doing it. Big banks, big professional traders, they're all home. The only people who are trading are retail investors. Who knows what the average retail investor is thinking? How do you gauge what a retail investor is thinking? They're just pressing buttons left and right. So I think it's a horrible day to trade. I'd recommend just taking the day off if you're a day trader. Professionals like Tomcat, who's a professional day trader, he's taking the whole day off. He's just saying, I'm done. I'm not even going to focus on oil.
I was talking about next week because if the whole demand cycle, if everybody traveled this weekend with demand coming in, that was my question. I apologize.
Yeah, I think it'll be interesting to see the traffic consumption numbers, see how that looks. I've found some really cool data on turnstile, New York City, turnstile, what is it? Not the subway, like turnstile subway data. And you can actually, I'm trying to put together a visualization where you can kind of track the movements. It's almost like are people increasing movement. It's really cool, actually. It's a data set that I found 2-3 weeks ago that I've been trying to work with. Really, really cool stuff. And I think you're seeing people begin to move around a little bit. I think I don't know. I just think there's so much. I think there's been so much positive news last week, and oil's been on a 2-week, 10-day bull run that I think you're finally seeing an exhale. And I think you might see, especially on a short week, for institutional side, Tuesday, Wednesday, I think you could see a depression. Do I think we necessarily get down to 25 bucks? No. I think 30 is probably the floor. Maybe $27 is maybe the floor. I don't see us getting that low. I think $30 to $35 is an accurate price for the oil and gas business right now, just based on where demand currently is. I think that's a decent price for it's where it should be. So I don't think you're going to push it above to 40, 45 bucks. I don't see that, even if demand comes roaring back. I think you're going to need to see 3, 4, 5 weeks of that before it's really going to make that leap. What's the Kreskin got?
Kreskin, 32.81.
32.81. Well, good. That means we're making a little bit of money on the shorts. So, because it's 32.35 right now. That's about all I'm doing. We are running long, though, but we're going to give you a sweet, sweet show. We're going to go ahead and call up our friends Nick and Steven first. We got Steven on the line here, so we're going to go with him first. High-level stuff from Nick and Steven. As always, we appreciate both of them. We know we took 2 weeks off chatting with him. He just got busy last week, so I'm glad we had a lot of stuff to chat about. It's been an insanely long show, and we're going to go and let you guys finish up your Memorial Day weekend. We appreciate you tuning in on a holiday. We thank you for listening, and we will be back tomorrow, Tuesday, for the digital ticker and a great, great week of content. We'll see you then.